Could you describe how you build your portfolio?
I run the M&G Global Macro Bond Fund. This is a truly flexible, go-anywhere bond fund, investing in all the different bond asset classes, whether that's investment-grade credit, high-yield, government bonds, inflation-linked bonds, but also currencies and all the different areas of the world, whether it's emerging market currency or traditional developed market currencies. So we want to be diversified across a range of different ideas and really make sure we're finding the best opportunities anywhere in the world for our investors.
Where do you find the biggest opportunities in the global fixed income universe?
We still like credit, and we still think you get overcompensated for taking credit risk, but certainly as the course of the year has gone on, yields have come down. So to some extent we're still overweight corporate bonds, but we've been taking some profits in some of the riskier areas of the market, in particular US high yield. Other areas where we see value are in inflation-linked bonds. So we think that something called central bank regime change is happening, where central bankers no longer care about inflation. They care a lot more about generating jobs and about reducing the debt burdens that Western governments have. And that means that there's a risk that inflation comes back into the system, but the markets aren't pricing that in at all. So the Global Macro Bond Fund has 20% invested in inflation-linked bonds that are pricing in just 1% inflation in a world where inflation is already 2.5% and could well go higher in future. So those are two key ideas that we have in the portfolio right now.
Why scale down your high-yield investments?
I mean, I think there are two big consensus in the bond markets right now, and they're both really about chasing for yield. You know, this is a world where interest rates are zero in most of the developed markets. You get nothing keeping your cash in a bank account or in a government bond. You even get negative yields in Denmark and Switzerland. So everybody's looking for higher yields, and that means it becomes a bit dangerous. In particular, emerging markets, which are one of these asset classes that have seen emerging market debt funds have just ballooned in size, and even some of the biggest global bond funds have over 80% of their holdings in emerging market debt. And it makes us a bit nervous that when all this hot money goes in looking for higher yields, that people forget about the fundamentals. And I think there's a bit of that going on in both US high yield and emerging market debt funds. So we've scaled back our positions in those asset classes considerably.
Why you're not so bullish on emerging market debts?
I mean, I think there are three reasons why emerging markets don't make sense right now. The first is that China is slowing down. Chinese growth will probably head down towards 5% per year at some stage in the next couple of years, and that's going to have a knock-on effect to the rest of the emerging markets. So, for instance, Brazil's biggest export market is China. If China slows, as it is doing, the rest of the emerging markets will also slow down. Secondly, it's all about valuation. You know, thinking about Brazil again, 20 years ago, Brazilian, or even 10 years ago, Brazilian government bonds yielded 20% yields. They now only yield 1% more than US Treasury bonds, the safest asset class in the world. And you're just not getting paid for the risks that you take in investing in emerging market debt. And finally, the third reason is that too much hot money has gone into emerging market bond funds. You go back 5 years ago, for instance, Peru, 30% of the Peru bond market was owned by foreigners. Today, over 60% of the Peru bond market is owned by foreigners. And that produces a risk. We all saw that, the tech bubble, the Asian crisis in 1997, when a huge amount of money goes into one asset class and then starts to slow down, that can be very, very damaging for the asset class. So those three things together mean that not only do we have zero weighting in emerging markets in the M&G Global Macro Bond Fund, we have a negative position. Using credit default swaps, we have short positions in Brazil, Indonesia, Russia, South Africa and Turkey. So I think that makes us very, very different from a number of our competitor funds.